Very good morning, my dear friends. We are in the chapter Amalgamation. Before proceeding further, let me give a quick recap till now what we have discussed in this chapter. So, reconstruction is the process of restructuring of existing financial statements because the existing financials are not depicting true and fair view. For that purpose, either we can go for internal reconstruction or either we can go for external reconstruction. In case of external reconstruction, the existing company is going to liquidate and a new company is incorporated in that place. But in case of internal reconstruction, due to making certain compounding activities and due to sacrifice made by certain other stakeholders of the entity attains certain profits. With that profits, the existing P&L account debit balance and the fictitious assets and any unrepresented assets we can set off. In the same internal reconstruction process, we are also go for either upward revaluation or downward revaluation of assets as per the plan. And the court approval is required in case of internal reconstruction, but such court approval is not required in case of external reconstruction. At that point, we also seen the concept of amalgamation, absorption, and external reconstruction, how it is different to each other also we seen. In case of amalgamation, a new company is incorporated to acquire two or more existing companies. In case of absorption, one existing company is going to take over another company. In case of external reconstruction, a new company is incorporated to take over the existing company. But the objectives might be different. In case of amalgamation and absorption, the objective may be to avoid the competition, to get the synergy benefits, to enjoy the economic scales, or it might to enjoy the taxation benefits as well. But in case of external reconstruction, the one and only objective is to show the existing financials at true and fair view. But why we combinedly learning all these three concepts put together in whatever the type of or method which you adopted, in each and every method, there are only two different types of entities exist. One is selling company and the other one is purchasing company. Altogether, in the chapter amalgamation, whenever I am talking, it includes absorption as well as external reconstruction. Sir, in this chapter, totally, we are dealing three different concepts. One is accounting treatment in the books of selling company and the calculation of purchase consideration and accounting treatment in the books of purchasing company. Out of the three aspects, for providing accounting treatment in the books of selling company, AS 14 is not applicable. We are applying generally accepted accounting principles to close the books of selling company. But for calculation of PC and accounting treatment in the books of purchasing company, we are going to apply accounting standard 14. So as per AS 14, amalgamation is broadly categorized into two types, which is amalgamation in the nature of merger and amalgamation in the nature of purchase. Sir, when an amalgamation is said to be amalgamation in the nature of merger, sir, if all the below 5 conditions satisfied, then which is known as amalgamation in the nature of merger. If all assets and liabilities of selling company taken over by the purchasing company, all assets and liabilities are transferred at book values only. PC should be paid only in the form of fully paid up equity shares only. But if any a fraction of share, then purchasing company may issue cash. Shareholders holding not less than 90% share capital in selling company should become the shareholders of the purchasing company after amalgamation, and the purchasing company should need to continue the same line of business as conducted by the selling company before amalgamation. Am I right? If all such 5 conditions satisfied, then which is merger. If any one of the condition is deviated, then the amalgamation is amalgamation in the nature of purchase. Sir, we already seen if the amalgamation is amalgamation in the nature of merger, then the method of accounting treatment we followed is pooling of interest method. Am I right? Pooling of interest method. If the amalgamation in the nature of purchase, then the method of accounting treatment we followed is purchase method. Am I right? So we seen such things as well. So related to purchase method, everything discussed in the last class, but pooling of interest method, we not yet discussed anything. Let me continue my flow. Sir, in calculation of PC, what are the issues we seen, sir? Sir, as per AS 14, amount payable by purchasing company to the shareholders of the selling company alone, we are treating as a PC. That means to whom we are issuing is relevant, but what we are issuing is completely irrelevant. Different methods of calculation of PC also we've seen: lump sum method, net payments method, net asset value method, intrinsic value method. In case of lump sum method, fixed amount is decided by the purchasing company. In case of net payments method, amount payable to equity shareholders of the selling company, amount payable to preference shareholders of the selling company, put together we will get PC. In case of net asset value method, assets taken over at the rate of agreed value, if you compared with the liabilities taken over at the rate of agreed value, then you will get net asset value of the business, which is equal to the purchase consideration. In case of intrinsic value method, PC is nothing but intrinsic value per share in the selling company multiplied with number of equity shares exist in the selling company. Am I right? So literally there is no difference between NAV method and intrinsic value method, but the way of expressing the things itself is different. Under NAV method, we are expressing as a difference between assets as well as liabilities. But in case of intrinsic value method, NAV per share multiplied with number of equity shares, just we are expressing. But the total components, what you can feel as a NAV, what you can feel PC under intrinsic value method, both are absolutely same. Is it okay, guys? And one more thing we also discussed, sir, PC either can be recorded at issue price or PC we can also record at par value. If PC is recorded at issue price, then whatever the calculation you applied till now, the same calculation you can able to continue. But if the same PC is going to calculate it at par value or at face value, then first of all, you should need to know number of shares issued as PC, then you should need to multiply with the face value. Sir, how you will get number of shares issued as PC, sir? That is total PC divided by issue price by the purchasing company. If you know, then you will get number of shares issued as PC. If you multiply number of shares issued as PC with face value, then you will get PC recorded at par value. Next, after that, we continued our journey with respect to accounting treatment in the books of selling company. Which approach we followed, guys? All of you, 5-step approach we followed. In step number 1, dismantling of balance sheet, all assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book value. If any of the asset or liability which is not taken over by the purchasing company, we separately open for the purpose of realization in the outside market. Because here purchasing company is not willing to take over that particular asset or liability, then what we can do? We can able to resell in the outside market. For the time being, just we are opening as a separate ledger without transferring to realization. Am I right? Next, sir, shareholders fund. In fact, equity shareholders fund like equity share capital, reserves and surplus, any miscellaneous expenditure not written off or any other fictitious assets are there, simply we can need to transfer to equity shareholders account. Preference share capital should need to be transferred to preference shareholders account. With this, dismantling of balance sheet is over. Then you can come to step 2, which is PC due. Purchase consideration due, the journal entry is purchasing company account at R to realization account, simply which is due entry at the time of sale. That is debtor account at R2, sales you are in generally right? Now here purchasing company account at R2, all assets and liabilities were parked under the realization account. That's why on behalf of crediting the assets, just simply you are crediting the realization account. That is the concept behind writing the journal entry for PC due. Next, you can come to step number 3, which is receipt of PC. Sir, in the form of PC, you may receive cash, you may receive equity shares of purchasing company, you may receive preference shares of purchasing company, or you may receive debentures of purchasing company as well. That's why entry is cash account at R, equity shares of purchasing company, preference shares of purchasing company, debentures of purchasing company to purchasing company. You should need to set off the debtor by creating the purchasing company. Now, you can distribute the PC in a particular order, but before distribution of PC, if any of particular asset or liability which is not taken over by purchasing company exists, you can realize it in the outside market. Now, with the resource and the existing PC, both combinedly, you should need to distribute in the particular order. The order is first liquidation expenses, after that secured creditors, after that unsecured creditors, then preference shareholders, then finally you can able to distribute among equity shareholders. Now, during the process, before making settlement to the equity shareholders, during the process of settlement, if you derive any profit or loss, such profit or loss you should need to you should need to transfer to realization account. That point also we've seen in one of our problem as well as example. While making settlement to preference shareholders, we derived certain loss as well as certain profits in some situation. Then at that particular scenario, you are transferring such profit or loss to realization account. Then before distributing amount among equity shareholders account, first you should need to close the realization account, find the profit or loss from realization. If it is profit, realization to equity shareholders. If it is loss, equity shareholders to realization. After transferring realization profit or loss to equity shareholders, whatever the available balance with the liquidator, simply such balance he would distribute among the equity shareholders. With that, all the existing resources like cash will going to close, as well as equity shareholders account also going to close. Now, to repay to the equity shareholders, not only the cash amount is available, but also the equity shares of purchasing company or any other resource may also available. So accordingly, just we may distribute, we will close such particular account as well. Like this, we are going to close the books of accounts of selling company. Am I right? Next, in the last class itself, we seen accounting treatment in the books of purchasing company. Sir, in the books of purchasing company, AS 14 is going to applicable and it plays the crucial role to decide the method of accounting treatment we need to follow. If it is amalgamation in the nature of purchase, the method of accounting treatment is purchase method. If it is amalgamation in the nature of merger, we should need to follow the pooling of interest method. Sir, in case of purchase method, what are the journal entries we should need to pass, sir? Now, at the time of purchase of business, the entries business purchase account are to liquidator of selling company. That is simply purchase to creditor. At which price you are going to purchase? At the rate of purchase consideration. Now, business purchase means what you are going to purchase? You are going to purchase assets as well as liabilities of the selling company. Now, you should need to cancel the business purchase as well as you should need to incorporate the assets and liabilities which are taken over from the selling company. At which value I should need to incorporate, sir? I should need to incorporate at agreed value, not at the book values of the selling company. Sir, if nothing is specified, then we can presume that the book value of the selling company with which we are agreeing. Am I right? So that's why the entry is assets taken over at the rate of agreed value. 2. Liabilities taken over at the rate of agreed value. Assets in generally having debit balance, that's why I debited. Liabilities in generally having credit balance, that's why I credited. Now the assets taken over minus liabilities taken over, we are deriving net asset value, which is NAV. Now you should need to cancel the business purchase by crediting the business purchase, which is equal to PC. So with this entry, really what is happening, sir? We are comparing the purchase consideration with the NAV. Sir, in case of NAV method, PC is equal to NAV, there may be no chance of occurring difference between PC and NAV. But if you are going to calculate PC by applying other methods like lump sum method or net payments method, then there may be a chance of occurring difference between PC and NAV. Then if PC is greater than NAV, the excess of PC, whatever you are paying to get the business of the selling company, the difference you can call it as a goodwill. If the situation is PC is less than NAV, while acquiring the business of the selling company, you are paying very less amount. The difference between PC and NAV, you can treat it as a capital reserve, which is actually a capital profits. One more important thing I told you, even though sometimes you are calculated PC under NAV method, still there may be a chance of occurring difference between PC and NAV. In which circumstance, when the PC is recorded at par value, even though PC is at NAV price, still there may be a chance of occurring difference between PC and NAV. That's why simply you may not conclude that, sir, if it is PC is under NAV method, there may be no difference between PC and NAV. You should need to check whether you are recording PC at par value, you are recording PC at issue price as well. Fine. Hope you understand. Here the second entry plays the crucial role while providing accounting treatment in the books of purchasing company. Next, you should need to make the final settlement entry, which is for liquidator of selling company, whatever you are paying, just you should need to mention liquidator of selling company account data to equity share capital to preference share capital. If it is issued at more than the face value, then the excess of premium you can make it credit to securities premium. If it is debentures, you should need to credit the debentures. Debentures can also able to issue at discount. That's why if debentures are issued at discount, then discount on issue of debentures also you should need to debit it. If it is cash component, you should need to credit the cash. I think so. Up to this, we explained in the last class. Apart from this, I also explained one more thing, if you really remember. What is that? Sir, if the amalgamation is amalgamation in the nature of purchase, the reserves and surplus of the selling company will not become the reserves and surplus of the purchasing company. But to comply the statutory provisions, the statutory reserves of selling company should need to be maintained by the purchasing company after takeover of the business. For that, in generally, we are passing one journal entry, which is amalgamation adjustment account data to statutory reserve account. If the time period expires, then we should need to make it reverse such entry statutory reserve account data to amalgamation adjustment account. Till the date of reversal, amalgamation adjustment account is shown as a negative balance under reserves and surplus. Anyway, you know, statutory reserves will be shown under reserves and surplus only. The reason is, sir, reserves and surplus of the selling company would not become the reserves and surplus of the purchasing company in case of amalgamation in the nature of purchase. Is it okay, guys? Next, one more important concept also we deal, that is the concept of liquidation expenses. Actually, we've seen accounting treatment related to liquidation expenses in selling company point of view as well as purchasing company point of view differently. Here, just I want to clarify at a single time what is the accounting treatment in the books of selling company as well as purchasing company simultaneously. Sir, if liquidation expenses, the first case is liquidation expenses paid, or sorry, bared and paid by selling company, then in the books of selling company, what is the journal entry, guys? You know, the original entry is liquidation expenses to cash. Liquidation expenses should be closed and transferred to realization. That's why the entry is realization to cash is the entry. So then in the books of purchasing company, no entry at that point of time because nowhere it is relevant to purchasing company. Sir, it was initially paid by selling company, but later on reimbursed by purchasing company. Then in the books of the selling company, no impact, no need to record. The reason is initially cash outlay is there. Then what is the entry we might pass? Purchasing company account data to cash we may pass. Then, sorry, yeah, right. When you are getting cash from the purchasing company, again cash account data to purchasing company. Then both will nullify to each other. Na? That's why the impact is nil. Then at that circumstance, in the books of purchasing company, the entry is goodwill account data to cash account is the journal entry. The logic I told you, sir, why you are paying to that extent of the liquidation expenses, why you are reimbursing to that extent of the liquidation expenses to the selling company is you are getting certain goodwill from the purchasing company, sorry, from the selling company. That is the reason why you are raising the goodwill. But such goodwill you are realizing, but the other persons are may not realizing such goodwill. That is only known to you. That's why you are debiting such goodwill. Am I right? That is the logic behind the debiting the goodwill account. Next, sir, it is directly incurred and paid by the purchasing company. Then at that point of time, for selling company, no entry straight away. In purchasing company, the similar entry, goodwill account at R2 cash account, it is going to pass. Now, simultaneously, I discussed accounting treatment related to liquidation expenses, both in the books of selling company as well as purchasing company. Is it okay, guys, all of you? Fine. So till now, our entire time dedicated for revision itself, it took almost 15 to 20 minutes. Now let me continue 2 to 3 more adjustment before discussing the accounting treatment in the books of purchasing company with a problem. Okay, still we are in the process of resolving problem number 1, I know. So let me continue to discuss 2 to 3 more adjustment. Please concentrate, all of you. So the next adjustment is intercompany owings. Intercompany owings. Concentrate, guys. Sir, what is the meaning of intercompany owing, sir? Intercompany owing means before occurring the process of amalgamation, there is a relationship in between purchasing company and selling company. Let us assume this is Rani Limited. This is Razo Limited. Now what happened? Razo Limited in generally selling goods to Rani Limited. So this is a selling company. This is a purchasing company. Usually Razo Limited selling goods to Rani Limited. So sales happen by adding profit of 10% to the cost. By adding 10% of profit to the cost price. Let us assume in the current year, the total sales happened at 1 lakh. The total sales happened at 1 lakh. Now, out of which, due to which, Rani Limited should need to pay to the extent of 1 lakh to the Razu Limited, which is a credit sale. Now, in Rani Limited balance sheet, Razu Limited will be treated as a debtor, na? That is under trade receivables. Here, Razu Limited showing as debtor. Similarly, in Razu Limited books, under liabilities, that is under trade payables, Rani Limited showing as a creditor. Do you agree, all of you? This is a normal credit sale and credit purchase of the transaction. In Rani Limited point of view, which is a credit purchase, that's where Razu Limited is a in reverse manner. I wrote now. Just a second. So for Rani Limited, I'm so sorry, guys. Still, I'm not leaving from my sleep. I think so. Please, for Rani Limited, which is a purchase means which is creditor. So trade payable. Just make it reverse. So for Razu Limited, which is trade receivable, because which is sale na? Sale means debtor na? Fine. Now it is correct. Please all of you concentrate. In Rani Limited, Razu Limited is a trade payable for 1 lakh. In Razu Limited books, Rani Limited is a trade receivable for 1 lakh. This is the thing happened simply due to credit purchase and credit sale of transactions. This is the impact. Now here my question is, once Razu Limited want to acquire the business of Rani Limited, then Razu Limited is ready to take over all the assets as well as all the liabilities. Am I right? All the liabilities means it is inclusive of trade payable. Then in Razu Limited books, this trade payable or this creditor also coming into the picture. Now all of you let me know, sir, is it have any meaning to incorporate Razu Limited creditor in the books of Razu Limited? Just you can think from your angle. In the books of Razu Limited, Razu is asking that I should need to recover money from Razu. Razu means whom? Myself. Can I able to recover money from myself? No, that is not possible and that is meaningless as well. Then what should I need to do? Then the trade payable should need to be make it set off with the existing trade receivable, because right now we are unable to recover from Rani Limited because Rani Limited completely dissolved. Rani Limited completely liquidated, as well as you are unable to ask money from yourself. That's why you should need to make it set off the trade payable with trade receivable by passing the entry trade payable account debtor, trade receivable account 1 lakh. So simply for intercompany owings, the journal entry is creditors account debtor to debtors account, or trade payable account debtor to trade receivable account. You should need to make it set off with the existing liability and the existing asset. Do you understand, all of you? Tell me, guys. Yeah, fine. Next, after intercompany owings, this is a simple adjustment. Let me take one more adjustment, guys, which is stock reserve. Stock reserve. So whatever the example I considered in the earlier case, let me continue the same example. Sir, the same example means here, which is Rani Limited exist, right? Here Razu Limited exist. So Razu Limited sold goods to Rani Limited at the rate of 1 lakh selling price. But how such selling price derived? Cost plus 10% profit. The same thing, right? Now, the thing is, Razu Limited purchased, Rani Limited purchased certain goods na. Selling company purchased certain goods from purchasing company na. Out of the goods purchased from purchasing company, certain goods are lying as closing stock. Certain goods are lying as closing stock. Sir, how much worth of goods are lying as closing stock, sir? Let us assume 10,000 worth of goods are lying as closing stock. Total, I purchased 1 lakh worth of goods. But out of which, the cost of 90,000 worth of goods was already sold to my customers. But to the extent of 10,000, unable to sell in the current year. That's why I put under closing stock. Now, again, the thing is, all of you please concentrate. In the process of amalgamation, purchasing company is going to take over assets as well as liabilities of Rani Limited, which is inclusive of the stock. Now, in Razu Limited books, it have their own stock. Their own closing stock, it have already. Now, along with that, we are also considering the closing stock of Rani Limited. That is simply stock of Rani Limited. 10,000. Now, my question is, sir, my own stock is at which price? My own stock is at which price? My original cost price. That is cost or NRV, whichever is lower means. So if you thought that NRV value is more than the cost, then you're always recording the cost. Now, the stock which is acquiring from the selling company is at cost plus 10%. Cost plus 10%. Now, in our organization, always to measure the inventory uniformly. For certain stock, we are measuring at cost. For the other stock, we may not measure at selling price, right? And if you want to apply the principle of AS2 as well, inventory should be valued at cost or NRV, whichever is lower means. Sir, if your selling price is, if you assume cost is 100, which is 10%, which is 110. If you assume cost is 100 or 110, whichever is lower means, for 100 only you should need to measure. That means for measuring the stock at 110 is not correct. Do you understand, all of you? To follow the principle of inventory, if you are measuring the inventory at selling price, which is violation of inventory valuation principle itself. Sir, that's why what I should need to do, sir, I should need to decrease the stock which is acquired from the selling company by passing one entry, which is to stock. But on behalf of writing to stock, just we are crediting as to stock reserve account. Sir, stock in generally, if you want to increase, you should need to debit. If you want to decrease, you should need to credit. That's okay, sir. Credit aspect, we understand. Then what about the debit aspect, sir? Can you guess anyone what is the debit aspect? Debit aspect is goodwill account again. The reason is very simple. You know, the stock value is 100, but still you are going to acquire at the 110. Why you are paying excess of 10 rupees to the selling company? The reason is, again, I know it has certain goodwill. So that's why I'm debiting the excess value paid to acquire that stock to the goodwill account. So the entry is goodwill account at R to stock reserve account is the net entry for creation of stock reserve at the time of acquiring the stock of the selling company. When the two, if purchasing company sold certain goods to the selling company, such goods are lying in the closing stock of the selling company, then only you should need to create the stock reserve by passing the entry goodwill to stock reserve account. Hope you all of you, hope it is understandable to all of you. Am I right? Can I proceed, guys? Do you have any doubt? Let me know quickly in the chat box. I'm waiting for your reply. If it is understandable, then I'll proceed with the other issues. Quickly, guys. What if the selling company had given loan to the purchasing company? Same, which is also like intercompany owings. You can extend the intercompany owings not only for purchases and sales, for loan receivable to loan payable, for bills receivable, bills payable, everything you can apply. The same thing, the entry is loan payable to loan receivable. Same. I think so. That question was asked by some of the students. That's why I resolved. Next. What if reserve situation is there? Reverse situation. Reverse situation is also same thing here. What if reverse situation means some of my friend, okay, Ed Kundalu, he is asking that, sir, you are applying the concept that purchasing company selling goods to selling company. Am I right? If selling company sold goods to the purchasing company, at that point of time also intercompany owings, there is no difference, because in selling company at that point of time, which is showing as a trade receivable, then for purchasing company we are showing as a trade payable. Again we are acquiring all assets and all liabilities, then again it will cancel to each other, trade payable to trade receivable, there is no difference. But coming here, if selling company is selling goods to the Razu Limited, if selling company selling goods to the purchasing company, then if goods are selling at their selling price, then in purchasing company the goods are at their own original cost. Now the purchased goods from the selling company is at a selling price. Again it will apply the same concept. That's why I'm not repeating the story. Whether the goods are purchased from either selling company by the purchasing company, or goods are purchased by purchasing company from the selling company, whatever the case you can take in, whether it is in reverse case, whether it is in the original case, there is no difference. To decrease the inventory for proceeding the inventory valuation uniformly, I should need to pass the entry goodwill account data to stock reserve account. There is no difference at all. Do you understand, all of you? Fine. Next. Please explain interowing, sir. What is their mind? Interowing. Interowing is nothing. It is nullifying with each other. Simply creditors with debtors you should need to nullify. Asset with liability simply you should need to nullify. Because once we are considering the other parties either liability or asset, then we should need to cancel with each other. That's it. What is there? Okay. Any other doubt, guys? Any other doubt? Yeah, fine. Guys, please, all of you, be careful. These concepts you should need to have a crystal clear idea. The reason is, whenever you are considering any problem, they are simply adding one adjustment with intercompany owings. They are simply adding the other adjustment with the stock reserve. If you're having the crystal clear idea, whenever they are adding to a particular problem, you can simply resolve. Fine. Now let me go to the further discussion, guys. I think so. I explained all the adjustment, and before going further, just I want to clarify one thing with you. Sir, whether it is amalgamation in the nature of purchase or amalgamation in the nature of merger, just leave it. You are acquiring assets as well as liabilities of the selling company. Am I right? Now, out of this liability, one of the liability is debentures of the selling company. Debentures of the selling company. Do you agree? If at all, selling company will have any debentures and the purchasing company is also ready to take over debentures of the selling company, then two liabilities taken over at the time of incorporation of liabilities, we are incorporating the debentures of the selling company as. Let us assume at which price debentures of the selling company you are acquiring, sir, which is we are acquiring at 1,10,000. Face value is at 1 lakh, but we are acquiring at 1,10,000. That's why I'm incorporated at 1,10,000. But whose debentures these are? Debentures of the selling company. But once selling company is liquidated, there is no value for debentures of the selling company. then what you should need to do for these debentures of the selling company, what you are paying, you should need to check. If you are paying cash, then debentures of selling company to cash, you should need to pass an additional entry. No, sir, you are issuing your own company debentures, then debentures of selling company accounted are to, if your company debentures you are issuing at 10%, then debentures of selling company to 10% debentures. Like that, you should need to pass. That means for cancellation of debentures of selling company and repayment to them, the journal entry is debentures of selling company accounted are, just a moment, what happened suddenly, it was bifurcated. Oh my god, just a moment, guys. Yeah, fine. So now the entry is debentures of selling company account data. If it is 1,10,000, let us assume, for example, you are issuing your own company debentures, then to 10% debentures account 1,10,000. No, sir, I'm issuing debentures at premium. Let us assume. So the face value is 1 lakh. Let us assume. Then the excess amount you are paying, you can call it as securities premium account, which is 10,000. No, sir, not like that. You are issuing your debentures at discount. Let us assume. Then debentures of selling company to 10% debentures, then you should need to debit the discount on issue of debentures. So based upon the given information, just you should need to cancel the debentures of selling company. You should need to issue your own company debentures. You should need to apply such concept as well. Sir, with this background, let us resolve the problem number 1 remaining other part, guys. Problem number 1 remaining other part. Please all of you come here. Problem number 1 other part. Let me read problem number 1 quickly once again, because we diverted meanwhile. I think so. We done problem number 1 in the last class with respective to selling company point of view, right? Let me quickly read out. So Y Limited acquired the business of Z Limited. Y Limited is the purchasing company and the Z Limited is the selling company. And in the share capital, two different types of shares are exist. One is equity shares, another one is 6% is preference share capital. And on the reserves and surplus, capital reserve, profit reserve, workman compensation reserve. Out of this 5,000 is the liability, and the remaining 3,000 will be the pure reserve. We decided. Then come to the long-term borrowing, 6% debentures is there. Under the PPE, land and building, plant and machinery exist, and intangible assets, goodwill and patent exist. So remaining, if you check other assets, inventory, trade receivable, cash and cash equivalents as it is given. And one of the liabilities, other current liability, which is interest payable on debentures also given. So trade payable as usually given. What is the further information we read at that point of time? Y Limited was to take over all the assets except cash and all the liabilities except for interest due on debentures, and to pay the following amounts. Rupees 2 lakhs face value, 7% debentures in selling company. For the existing debentures in the purchasing company, for the purpose each debenture of the selling company is to be treated as worth 105. What he is conveying indirectly, purchasing company is ready to take over debentures of the selling company by paying 105 per each debenture. Simply he is telling that acquisition price for each and every debenture in the selling company is 105 rupees. At the time of incorporation of assets and liabilities, now debentures of Z Limited, you should need to be incorporated at 2 lakh into 105%, which is 2,10,000. Am I right? Fine. Sir, for each preference share in Z Limited, 10 rupees in cash and 9% preference share of 100 rupees each in Y Limited. We already considered in calculation of PC under net payments method, I think so. For each equity share in Z Limited, 20 rupees in cash and one equity share in Y Limited of 100 rupees each, having the market value of 140. Expenses of liquidation of Z Limited are to be reimbursed by the Y Limited to the extent of 10,000. Actual expenses amounted to 12,500. Y Limited valued land and building at 5,50,000, plant and machinery at 6,50,000, patents at 20,000 of Z Limited for the purpose of amalgamation. These all are agreed values. Sir, except these assets and liabilities, for all remaining assets and liabilities, purchasing company acquired it book value only. Sir, if there is no information means we are acquiring at book value only. But for these building, plant and machinery patents, we are acquiring it other than book value, which is nothing but agreed value. Out of which we already calculated the PC. We already done with the closing ledgers in the books of selling company. Now this is the time for journal entries in the books of purchasing company. Am I right? Please all of you come to purchasing company journal entries first. You should need to participate from your side, guys. Please all of you apply your mind, then only you can able to resolve. Purchasing company. Sir, which method, guys? Amalgamation. Which method of amalgamation? Amalgamation in the nature of purchase. How you know? Anyone, can you please give your answer? How you know which is amalgamation in the nature of purchase and we should need to apply the purchase method? Sir, it is clearly given that some of the assets and liabilities are not taken over. Cash is not taken over by the purchasing company. One of the liabilities is not taken over by the purchasing company. And moreover, those assets which are taken over by the purchasing company are more or less than the face value or more or less than the book value of the selling company. That's why definitely if it is amalgamation in the nature of purchase only. Now, the first and foremost entry, business purchase account data. What you are purchasing? Business purchase account data to liquidator of selling company. Here selling company means Z Limited. Guys, PC is how much? We already calculated the purchase consideration in the last class. Please all of you open that. So PC is how much? 17,20,000 is the purchase consideration. The same amount with which you can record here. 17,20,000. Now all of you, what we should need to do? We should need to incorporate assets as well as liabilities by cancelling the business purchase. What are all different assets you are considering? Now, assets taken over. One by one asset, please all of you let me know, guys. For assets, first property, plant and equipment. Both the assets you are considering, that is land and building and plant and machinery. Now, land and building account debtor. At which value you should need to incorporate? At agreed value. Agreed value given how much? 5,50,000. But if you check the book value is 4 lakhs. So don't consider the book value in the books of purchasing company. You should always consider the agreed value only. So 5,50,000. Next, plant and machinery account debtor. How much plant and machinery? 6,50,000. Next, patents account debtor. How much patents? 20,000. What are all other assets, guys? We are taken over. Goodwill, right? Goodwill is there, right? So for the time being, just ignore the goodwill. I will tell you at the appropriate time we'll consider. If you want, you can write here, but just for the time being, you can ignore. Apart from the goodwill, is there any other asset? Please check all of you. Inventories is there. Inventory is at 1,50,000. Nothing was given means, which is also taken over at book value only. Next, trade receivables at 1,80,000. Can I consider cash and cash equivalents? Cash and cash equivalents is not taken over by the purchasing company. Okay. Now you can come to liabilities side, guys. To liabilities, consider one by one. Under long-term borrowings. Long-term borrowings, what is the component? Debentures, 6% debentures, which is to 6% debentures of selling company. This is not your company debentures. That's why you should need to mention 6% debentures of selling company. At which value we are acquiring, which was clearly given in point number A. 2 lakhs face value, 7% debentures in Y Limited. In Y Limited means in purchasing company. For the existing debentures in the Z Limited, for the existing debentures of selling company. For the purpose, each debenture of Y Limited is to be treated as a worth of 105 rupees. Sir, whatever the debenture we are issuing, you can consider it as at the rate of 105 means now the face value is 100. 2 lakhs divided by 100 means we are issuing 2000 debentures. We are issuing 2000 debentures means each debenture at 105 rupees means 2000 into 105, which is equal to how much, guys? 2000 into 105, which is equal to how much? 2 lakh, 10,000. Okay. Next, this is the acquisition price of the debentures. What are all other liabilities we are considering, guys? Please, all of you cross verify quickly. Trade payables, nothing was mentioned means we are acquiring it. Book value only, it is at 1,20,000. Sir, is it outstanding interest on debentures is taken over by the purchasing company? No, it is clearly given except cash and outstanding interest of debentures. Except cash and outstanding interest on debentures, all assets and all liabilities taken over by the purchasing company. Hope we considered all the liabilities, all outside liabilities. Am I right? Fine. Now you should need to cancel business purchase. To business purchase account, which is at 17 lakh 20,000. Guys, if you observe here, we consider all assets except goodwill and all the liabilities as well. Now here my point is, please all of you calculate NAV before considering the goodwill. Sir, here goodwill is not yet considered now because we are taken over as a purchasing company. We are taken over goodwill of the selling company also. I know that, but intentionally I ignored without considering the goodwill. Can you please all of you work out net asset value of the business taken over? Guys, I forgot to inform you. Today morning only, just I realized that my calculator is not working. I am unable to make any calculations. I was completely depending on you. Okay, I'm completely depending on you. Please, all of you make it calculations and let me provide the answers. Quickly, all of you. What is the NAV? Total of the assets minus outside liabilities. Assets taken over. NAV answers quickly I required. Assets taken over at the rate of agreed values. Less liabilities taken over at the rate of agreed values. Sir, if answers will commit as a late, then I will take help of my PDF. Already I have answer with me. Then for calculations, at least I can able to depend on my PDF. Please quickly, all of you. NAV is 6,35,000. Is it correct? No, I think so. It's not correct. 12,20,000. So many different answers are coming here. Huh? What happens? Let me check with my PDF. Okay. So here PDF is there. Let me cross check. Plant and machinery 6,50,000. Land and building 5,50,000. Patents 20. Yes. Inventory is at 1,50,000. Trade receivable is at 1,80,000. Absolutely correct. And 6% debentures of selling company 2,10,000 and trade payable 1,20,000 and business purchase 17,20,000. We considered all assets and all liabilities except one liability, guys. What is that liability means? If you come to the PDF, sir, out of 8,000 expected liability 5,000 is there na, which is also one of the liability na, workman compensation liability. That 5,000 is also taken over by whom? Purchasing company only. Okay, so please all of you add that one also. We are ignoring. So workman compensation liability, which is for 5,000. Am I right? Is it 5,000 only? Now you can work out correct NAV. How much? Quickly, guys, all of you. Correct NAV. Please, all of you consider this one as well. Then let me know the correct NAV. It's 12,15,000, correct? Yes, it is correct. Now the NAV is nothing but 12,15,000. Simply what you should need to do, you should need to add all assets and you should need to reduce all the liabilities. Then you are getting 12,15,000. Now in second entry, we should need to compare PC with NAV. Na? Purchase consideration, we already calculated in working note, or it's in the first entry itself you have, which is 17,20,000. Now let me know what is the situation. Is this PC is greater than NAV or PC is less than NAV? PC is greater than NAV, the situation. If PC is greater than NAV, then goodwill is how much? Then goodwill is how much, guys? Which is 17 lakh. The difference of 17,20,000 and 12,15,000 is the goodwill. How much, which is, guys? All of you quickly. It's 5,05,000. Absolutely correct. It's 5,05,000. Now the difference you can put it as goodwill account, which is 5,05,000. Now all of you please observe, still my explanation is not yet over. You may ask one question that, sir, you are calculating the NAV without considering the goodwill, because goodwill is also one of the asset taken over by the purchasing company. Am I right? Why you are doing like that, sir? If you want to consider the goodwill in calculation of NAV itself, you can consider. I will not object you, but again, you should need to pass one more goodwill, the difference as PC and NAV. For example, this is 5,05,000. You are agreeing with me, right? Just let me check the alternative thing. Let me check the same entire situation. Let me resolve the entire situation in another angle. Sir, apart from the given assets, we are also considering the goodwill of the selling company, right? So goodwill of the selling company, how much? 2,40,000. Now first you can incorporate the goodwill of the selling company at the rate of 2,40,000. Please all of you consider. Now let me know NAV how much. If you consider this 2,40,000 also, then let me know NAV how much, which is 14,45,000, right? Right? If you consider this goodwill of 2,40,000, then NAV is how much? 14,45,000. I'm not having calculator with me. Please all of you respond quickly, guys. It's 14,55,000. Okay, fine. It's 14,55,000. Am I right? Absolutely correct, right? Then you can compare the PC with 17,20,000. Then let me know goodwill how much. In that particular scenario, goodwill is how much? All of you. Goodwill is how much? What is the difference between 17,20,000 and 14,55,000? Goodwill is 2,65,000. Now, earlier you incorporated 2,40,000 as an acquired asset. Now, while comparing PC with NAV, you are erasing another amount of goodwill, which is 2,65,000. Again, you are unable to write goodwill account data 2,65,000, right? Now the total goodwill 2,40,000 plus 2,65,000, which is equal to the earlier represented goodwill, which is 5,05,000. On behalf of recording the double time the goodwill, what you can do simply, you can simply record by debiting the goodwill with 5,05,000. That is the point I'm explaining here. That's why on behalf of debiting double time, you can directly write with 5,05,000. Then how our thought process should be, sir. If at all purchasing company is acquiring goodwill of the selling company also, then no need to incorporate directly. You will derive it as a difference between PC with NAV as a goodwill or capital reserve. Do you understand? That means even though purchasing company is acquiring all other assets along with goodwill, don't incorporate in the second entry. While comparing PC with NAV, it will be automatically incorporated. But if you want to try to incorporate initially, if you are erasing goodwill one more time, then you need to erase and you should need to put again the total value. So that's why simply I'm telling that if purchasing company is taken over the goodwill of the selling company, no need to incorporate. While comparing PC with NAV, you're automatically incorporated the goodwill of the purchasing company, sorry, the goodwill of the selling company, along with the difference of PC and NAV. That is the point here I'm highlighting through this problem. Is it understand, guys, all of you? it's okay. Even though if the PC is less than NAV, you are telling that, sir, if the PC is greater than NAV, then the situation is goodwill, then it holds good. If PC is less than NAV, still you can apply. Still you can apply. You know the reason? I will tell you. Don't be confused. For example, if goodwill was erased, in your organization, capital reserve is there. You can cancel goodwill with capital reserve. Even though the situation is holds good, if PC is less than NAV as well, yes, you can apply the same concept. What I'm trying to tell here, purchasing company is ready to take over goodwill of the selling company. But the situation is not PC greater than NAV, sir. PC is less than NAV. Then at that point of time, if you are not incorporating the goodwill, that may leads to the wrong direction. No, that doesn't leads to the wrong direction. The reason is at that point of time, what you are doing, you are incorporating the capital reserve. That's correct only. Without incorporation of the goodwill, you can incorporate the capital reserve. The reason is, again, I'm telling you, don't be confused. If you want to record the goodwill first, which is acquired from the purchasing company, now PC is less than NAV. If you want to record the capital reserve, now the goodwill can be need to set off with the capital reserve ultimately. Then rather than doing all such things, you can directly credit the capital reserve component itself. That is my point of explanation. So my conclusion is, whether the PC is greater than NAV, whether the PC is less than NAV, if the purchasing company is acquiring the goodwill of the selling company, no need to incorporate separately. At the time of comparing PC with NAV, that component was automatically considered. Please, all of you put that point into your brain. Okay, super. Yes, that's correct, ma. That's correct. Yeah, fine. Let me continue the next entry. I'm responding to the queries here. Don't think that to whom I'm talking. I'm checking my queries. Just the person who asked the query, just now he provided the answer. Fine. Let me go with the third entry. Sir, what is the third entry, sir? Now you should need to make payment to the liquidator of Z Limited. So liquidator of Z Limited account debtor. How much you should need to pay? 17,20,000. How you are paying? We have everything in PC calculation. You can go to the PC calculation. Here it is there. Sir, in the form of cash, I am paying 40 plus 1,60,000. 2 lakhs in the form of cash I am paying. In the form of 9% preference shares, I am paying 4 lakhs. In the form of equity shares, I am paying 11,20,000, but out of which face value is 8,000 into 100. Face value is 8 lakhs. Amount over the face value is 3,20,000. Now this will goes to securities premium. So the entry is to cash 2 lakhs, to 9% preference share capital 4 lakhs, to equity share capital 8 lakhs, to securities premium 3,20,000. Do you understand, all of you? Please, all of you come here. To cash 2 lakh, to 9% preference share capital. How much, guys? To 9% preference share capital. Just now we see 4 lakhs, which is 4 lakhs. Next, to equity share capital. Equity share capital, how much? 8 lakhs is the face value, and the securities premium is 3,20,000. Always the company who is going to issue the shares, always you should need to make it credit to the extent of face value only. Sir, if the company is going to issue over and above the face value, which should need to be make it credit under securities premium account. So now you can make it total 2 plus 4, 6, 6 plus 8, 14, 14 plus 3,20,000, which is leads to 17,20,000. Fine. Sir, with this entries are over? No, not yet over. Out of the liability, one of the liability is 6% debentures of the selling company. You should need to cancel the 6% debentures of the selling company. You should need to issue your own company debentures. It is clearly given, rupees 2 lakh 7% debentures in purchasing company for the existing debentures of the selling company, for which each debenture of purchasing company is to be treated as worth of 105, like that it is given now. So that's why you should need to cancel 6% debentures of Z Limited. 6% is debentures of selling company means 6% debentures of Z Limited account at R. 2,10,000. You can issue your own company debentures. The face value is at 100 rupees to 7% debentures account. Sir, 2000 debentures into 100 rupees, which is equal to 2 lakhs. The excess price with which you are issuing, you should need to credit it to securities premium account, which is 2000 into 5 rupees, which is equal to 10,000. So the entry is 6% debentures of Z Limited account at R to 7% debentures to securities premium account is the entry. Guys, is there any other adjustments were given, like any intercompany owings? No. Any stock reserve concept? No. But there is a concept of liquidation of expenses. I mean liquidation expenses. Sir, expense of liquidation of Z Limited are to be reimbursed by the Y Limited to the extent of 10,000. That component only relevant for the purchasing company. The actual expenses of selling company is not relevant. How much worth of expenses you are reimbursing? 10,000. For that, you should need to pass the entry goodwill to cash. Goodwill account at R2, cash account 10,000. For that, you should need to pass the entry. Is there any other points impacting in the books of purchasing company? No, no more. All the entries we consider. Now, after this, in the examination, if they ask that, you should need to prepare the balance sheet. Based on the impacts given in the purchasing company through these journal entries, for the existing balance sheet, you should need to revamp a new balance sheet. That we can do it from other problem, because in this problem, we done with calculation of PC, we done with the accounting treatment in the books of selling company, and journal entries in the books of purchasing company also we seen when the amalgamation is amalgamation in the nature of purchase. So we will resolve the balance sheet through another problem, guys. And you can please all of you go for the break. And after the break, what we are going to do, first for 2 to 3 problems, we are concentrating on calculation of PC problems, because regularly they are testing questions from calculation of PC for 5 marks. The reason is very simple. Along with the chapter amalgamation, AS14 is also there, one of the standards separately given in the group 2 material. Now, out of the standard, they are regularly asking question for calculation of PC. But we are unable to teach AS14 separately and this chapter amalgamation separately. We combine both the topics. Do you understand? So that's why for our next 2 to 3 problems, we will give concentration on resolving calculation of PC. Is it okay, guys? Please, you can go for the break. All of you, please assemble by 8:17 exactly. Welcome back, guys. Let us quickly resolve certain problems related to PC, as I told you. Yeah, please all of you come to problem number 2, guys. S Limited is absorbed by P Limited. Sir, P Limited means is a purchasing company. S Limited means is a selling company. The draft balance sheet of S Limited is as under. First, let me read the requirement. You are required to calculate the purchase consideration. P Limited has agreed to issue 9% preference shares of rupees 100 each in the ratio of 3 shares of P Limited for 4 preference shares in S Limited. Simply for every 4 shares in the selling company, they are getting 3 shares. Am I right? How many number of preference shares exist? If you can check here, 2000 preference shares are there in the selling company. Then for every 4 shares, 3 shares means then for 2000 shares, how many shares we should need to issue? 2000 into 3 by 4. That too, each share is contributing 100 rupees. That's why amount payable to preference shareholders. Quickly, all of you let me know how much this fraction value. 2000 multiplied with 3 by 4 into 100. Let me know the answer, guys. As I told you, I didn't have any calculator with me. So please, all of you, let me know the answer. Okay, anyway, just leave point number 1. Whenever I'm getting answer through chat box, I'll put that. I'll go into the another point. Sir, to issue to the debenture holders in the S Limited, whatever the amount we are payable to the debenture holders, that we should not consider. Okay, this amount is 1,50,000. I got from from our students. Okay, fine. So point number 2, we not at all considered because to issue to the debenture holders in S Limited, amount payable to the shareholders of the selling company alone we are considering. Don't consider point number 2. You can come to point number 3. To pay 20 rupees per share in cash. 20 rupees per share in cash means 5,000 equity shares we have. Now 5,000 into 20, which is 10,000, right? Am I right, guys? So total amount in the form of cash payable to equity shareholders is 10,000, and to issue 6 equity shares of 100 rupees each, the market value of rupees 125 in lieu of every 5 shares held in S Limited. For every 5 shares held in S Limited means for every 5 shares, we are going to issue 6 equity shares. How many number of equity shares we have in the books of selling company? 5,000 equity shares. Then for 5,000, how many number of equity shares need to issue? 6,000 equity shares we should need to issue. 6,000 into share issue price is 125 right now into 125. If nothing was mentioned, PC is always recorded at issue price. If it is specifically mentioned PC is recorded par value, then only you should need to consider. Now 6,000 into 125, how much, guys? This is how much? Amount payable to equity shareholders, how much? This is 1 lakh, na? I'm so sorry. So completely depending upon calculators, na? That's why even we forgot how to calculate as well. Okay, just let me know this fraction. This calculation 6,000 into 1,25,000, which is equal to 7,50,000. Am I right? Let me open this here, my calculator. 6,000 into 125. So which I got 7,50,000. You are correct. Now, sir, method of PC is you might already observe, which is net payments method. Why? Because while reading the problem, we can able to ascertain amount payable to preference shareholders as well as amount payable to equity shareholders. That's why PC amount is equal to this 1,50,000 plus 1 lakh plus 7,50,000. Total how much? PC is equal to 10 lakhs. Am I right? Purchase consideration is 10 lakhs. So like these problems, they might ask in the examinations for 5 marks regularly. Next, you can come to problem number 3, all of you quickly. This is also related to calculation of PC only. Okay, please all of you come to problem number 3. Neil Limited and Gagan Limited amalgamated to form a new company on 1/4/2015, which is pure amalgamation, guys, because a new company is incorporated to take over two more companies. Following is the draft balance sheet of Neil Limited and Gagan Limited as at 31st March 2015. Come to assets, plant and machinery, buildings, current assets. Come to liabilities, capital given, current liabilities also given. Following are the additional information. The authorized capital of the new company will be 25 lakhs divided into 1 lakh equity shares of 25 each. Liabilities of Neil Limited includes 50,000 due to Gagan Limited. For the purchases made, Gagan Limited made a profit of 20% on sale to Neil Limited. Guys, for calculation of PC, this information is not relevant for me, not required. Even point number 1 is also not required. But for knowing the face value of equity share, just we can use at least point number 1. But point number 2 is only useful to provide accounting treatment in the books of purchasing company. For calculation of PC, that point is not at all necessary. Next, Neil Limited had purchased goods costing 10,000 from Gagan Limited. All these goods are included in the current assets of Neil Limited. This is also not required. Point number 2 and point number 3 only related to providing the stock reserve and intercompany owings while providing accounting treatment in the books of purchasing company. The assets of Neil Limited and Gagan Limited are to be revalued as under plant and machinery and building. These are the revalued figures. Why these revalued figures are given, we don't know. While if you read the problem till the end, then you may connect the dots. The purchase consideration is to be being discharged as under issue 24,000 equity shares of rupees 25 each fully paid in proportion of their profitability in the preceding 2 years. Okay. Profits for the preceding 2 years are given below. First year profits are given, second year profits are given. So 4,75,000, 5,25,000. What he is simply telling that purchasing company is ready to issue 24,000 equity shares to the selling companies combinedly. But for Neil Limited, how much, sir? Gagan Limited, how much, sir? If you want to know, if you distribute this 24,000 in is to 5,25,000 ratio, then you can simply understand how many number of shares received by Neil Limited, how many number of equity shares received by Gagan Limited. That is the information he is providing. Next, issue 12% preference shares of rupees 10 each, fully paid up at par to provide income equivalent to 8% return on net assets in the business as on 31st March 2015 after revaluation of assets of Neil Limited and Gagan Limited respectively. Sir, amount payable in the form of equity shares to Neil Limited, Gagan Limited, we understand. But how many number of 12% preference shares or how much worth of 12% preference shares we should need to issue to Neil and Gagan Limited was prescribed in point number D, but we can't understand that point, sir. Please concentrate what he is telling. Issue 12% preference shares of rupees 10 rupees each, fully paid up at par to provide. Sir, I will issue the face value of 12% preference shares of 10 rupees each. The total face value of preference shares I am going to issue to provide income equivalent to. Sir, income to whom, sir? This is income to whom? Preference shareholders. For preference shareholders, what is the income? Dividend is the only income. That means if you multiply the face value into 12%, which is equal to the income equivalent to means is equal to 8% return on net assets. 8% return on net assets. Sir, net assets is nothing but NAV. If you calculate the NAV on that, if you apply the 8%, which is equal to face value of the preference shares into 12%. Then what we should need to calculate here, that X we should need to calculate. Then we will know easily how much face value, how much worth of face value of preference shares issued by the purchasing company to the selling company. Now, how to calculate the net assets means after revaluation of assets of Neil Limited and Gagan Limited respectively. That means here some of the assets were given now. Now the revalued figures you should need to consider. For other assets, you can consider the book value, then calculate the NAV. On that, you can apply the 8%, that is equal to X into 12%. If you calculate the X is equal to 8% into net assets divided by 12%. You will get the amount of face value of preference shares to be issued to the selling company as well. Now, how much worth of equity shares you are going to issue and how much worth of preference shares you are going to issue. If you combinely then you will get the total purchase consideration. Then you should need to require the PC, equity and preference shares issued to Neil Limited and Gagan Limited. If you know the PC, then if you divide it with the issue price, then you will get number of equity and preference shares issued to Neil Limited and as well as Gagan Limited. Now, first of all, after reading the entire problem, I'll ask you one question. What is the method of PC? What is the method of PC? Just let me know, guys, all of you. What is the method of PC? No one is providing any answer here in the chat box. Is it lump sum method? Is it net payments method? Is it NAV method? Is it intrinsic value method? Still, I am waiting for the answer. I am asking the question again. One student, he is asking question to me. Sir, which method is applicable? Okay. Guys, don't be confused while applying the method of PC always. Okay. They're always providing the information in such a way that student will tempt in the wrong mode. Only one thing, whenever they are asking something related to PC, you should need to think only one thing. Whether you can able to ascertain amount payable to equity shareholders and amount payable to preference shareholders of the selling company. Yes, sir. Sir, how you are calculating that is irrelevant to me. Amount payable to equity shareholders, here I will know by applying the ratio of profitability. Amount payable to preference shareholders of the selling company, I know by applying certain percentage of return on net assets. That is again irrelevant for me. But if you are able to ascertain amount payable to equity shareholders as well as preference shareholders, the method of PC is net payments. That's it. Yes, maybe to know amount payable to equity shareholders, they give certain other information in another problem. They may give some other ambiguity situation they may create. But you should need to know only one thing. Sir, by applying such information, can you able to ascertain amount payable to equity shareholders? Yes, sir. Can you ascertain amount payable to preference shareholders? Yes, sir. Then the method of PC is net payments method. That's it. Fine. Please all of you come to my OneNote. Guys, please all of you help me out with your calculations. Problem number 3, right? Calculation of PC in bracket net payments method. So first, to equity shareholders, total give the 3 columns particulars. Neil is there, Gagan is there. 2 companies are there, na? 2 selling companies are there. Then you can start with 2 equity shareholders. Fine. What he told simply, sir, purchasing company is going to issue 24,000 equity shares in the ratio of 475 is to 525. So both will easily divided with 25. 25, 19 ja 475, 25, 21 ja 525. So simple is 19 is to 21 ratio. I should need to divide the 24,000 equity shares. Am I right? Fine. To equity shareholders, 24,000 equity shares at the rate of 25 rupees each. Am I right? Now out of which for Neil, 24,000 into 19 by 40, for each share 25. For Gagan, 24,000 equity shares into 21 by 40. For Gagan, the fraction is 21, na? 40 into 25. Am I right? So simple ratio, guys, 19 is to 21. Now please let me know this component answer and this component answer as well quickly. This is how much? 24,000 into 19 by 40 into 25. No one is providing any answer here. Can I go to my calculator? Where is my calculator? Yeah. So it is 24,000 multiplied with 25 into 19 by 20. So for 5,70,000, I got, all are telling different answers here. It's 5,70,000, am I right? Still different answers. Just a second, please, all of you. Let me take help of my PDF. Okay. Problem is problem number 3. Then my calculation part is wrong. My calculator, that is the system calculator, na? Yeah. Now 24,000 multiply with 19 by 40 into 25. So which leads to 2,85,000, guys. Persons who told 2,85,000 is correct. That's fine. Then for Gagan, which is how much? Then for Gagan, which is how much, guys? So 24,000 into 21 by 40 multiplied with 25, which is 3,15,000. Just I'm taking help of my PDF. You can cross verify it. Okay, fine. Sir, calculative part, I don't want to concentrate because I'm not having calculator with me. So just I'm believing my answer with my PDF. Just you can cross verify. Next, come to preference shareholders. To preference shareholders. All of you please concentrate. How we are working amount payable to preference shareholders. It is clearly given that issue 12% preference shares of 10 rupees each, fully paid up at par. That is, how much face value of preference shares I should need to issue, I don't know. But whatever the face value of preference shares I issued, the total worth of the face value of the preference shares on which if you calculate the income means which is 12%, which is equal to the 8% written on net assets. Then I know face value of the preference shares to be issued equal to 8% into net assets divided by 12%. To resolve this equation, first you should need to know the net assets. That's why let me go to the calculation of net assets under working note. Okay. Go to working note 1, calculation of net assets. So again, particulars, Neil, Gagan. Sir, some of the values are agreed values. Concentrate, all of you. Plant and machinery building. Given plant and machinery as well as building, please all of you consider agreed values. 5,25,000, 6,75,000. Next, related to building, 7,75,000, 6,48,000. Now assets minus outside liabilities means not only plant and building, any assets are there, you can check. Plant and building over current assets. As it is book value, you can consider current assets. Quickly, all of you. Just a second. One note was hanging. Yeah. Now you can go to the current assets. So please consider the as it is figures of the current assets. 1,63,500. Another one is 1,58,600. Less liabilities. Come to the liabilities. Only current liabilities are exist. 6,23,500. And for Gagavan, which is 5,57,600. Please, all of you, net assets. Net assets are NAV of Neil Limited and Gagan Limited. Quickly. All of you guys, let me know. For Neil, how much? For Gagan, how much? Still, I am waiting for your answers. So for Neil, I got 8,40,000 in my PDF. Can you please confirm, is it right? 8,40,000 is correct component, right? Here it is 9,24,000. Yes, some of my friend told exactly 9,24,000. So now all of you please concentrate here. How many number of preference shares, how much worth of preference shares we should need to issue? How we will know? I should need to resolve one equation. Nah? What is the equation? We already worked out, which is 8% into net assets divided by 12%. Am I right? That is the face value of the preference shares to be issued. Now, here 8% into, concentrate all of you, net assets. How much net assets we got? 8,40,000 divided by 12% for nil. In the same way for Gagan, 8% into net assets, how much? All of you, please let me know quickly. 9,24,000 divided by 12%. This is issue price of preference shares to the preference shareholders of the selling company. Now, all of you, please let me know the calculation part of this. How much? Tell me, guys, please participate, all of you. So I got in the form of preference shares for nil 5,60,000. Am I right? Is it 5,60,000? This component we got 5,60,000, guys. Next for Gagan, which I got 6,16,000 as per my PDF. Please, all of you confirm. Is these figures are correct? Now let me know the total PC. This is PC. Sir, 5,60,000 plus 2,85,000. Total how much here? Here I got 8,45,000 and here I got 9,31,000. Again, as per my PDF, I'm not calculating anything. Just as per my PDF answer, just I put it, the totals. Is it right, guys? So PC for nil 8,45,000, for Gagan, which is 9,31,000. Mr. Jai Kumar, he is telling different PCR. Guys, please, all of you, let me know my final answers are correct or wrong. Is it calculative portion? Correct, right? Please confirm at least one student. Then I can go with the other problem at least. So you can consider here, this is my original notes. Correct, right? 8,45,000, 9,31,000. That's correct, right? Fine. So many of our friends are telling the same answer. Please, all of you, be careful with the calculation part. I'm not concentrating on the calculative part. Just I'm concentrating on the concept. Guys, do you have any doubt in this problem? So one more time, I'm repeating. Here, how much worth of preference shares we should need to issue? It will decide the profitability ratio. Sir, how much worth of preference shares we should need to issue? It is depending on the net assets. If you know the net assets, if you apply the 8% on the net assets, which is equal to the income on the preference shares you are going to issue. That's why the worth of preference shares should need to issue is equal to 8% written on net assets divided by 12% we are applying. Based on that, we simply work out the face value or the issue price of the preference shares we issued. If you make it total, the worth of equity shares and worth of preference shares, then you will get the PC under net payments method. Okay. Fine. Super. Now let me go to the other problem. It is too difficult whenever the calculator is not exist with the commerce student. Now I understand. I feel the difficulty. Okay. Fine. Come to problem number 4, guys. Let us consider the balance sheet of X Limited as of 31st March 2011. Okay, what he required. This is the final problem for PC calculation, guys. Come down. Compute the purchase consideration. What they required? PC calculation. Sir, after reading the problem, please all of you identify again which method of PC you should need to apply. Don't ask me again. Okay. Share capital given. If you check share capital under note number 1, equity shares are there for 7,50,000 equity shares. 25,000, 14% preference shares are also there. Now, if you come to the reserves and surplus, general reserve is there. Then further, long-term borrowings are there under note number 3. Under long-term borrowings, 14% debentures are there at 40 lakhs. Rupees are in thousands. That's why which is 40 lakhs. Next, trade payable is another liability. So total liabilities are only two things, debentures and trade payables. Coming to assets under property, plant and equipment, what he is giving? Land and building, plant and machinery, furnitures. 3 components are there in the plant and machinery. Sorry, in the PPE. Next, non-current investments was given. So non-current investments, if you check, investment at cost price was given, which is at 5 lakhs. So the other assets, current assets, inventory, trade receivable, cash and cash equivalent. While resolving the problem in the exams also, you should need to check the balance sheet in that mode only. Don't check any number. All of you just concentrate on what are all different components given in the balance sheet. What is the face values? Is it we have equity? Is it we have preference? Is it we have debentures as well? What are all different assets components also we have? Just you should need to think. No need to remember the entire information. Just the outline you should need to remember. Next, come to the additional information. Y Limited takes over X Limited on 10th April 2021. Sir, Y Limited takes over X Limited means Y Limited is a purchasing company. X Limited is a selling company. Am I right? So now the given information is related to whom? The given information is related to whom, guys? X Limited. That is always, if you are observing from problem number 1, they're always giving the selling company information only. Next, further information. Debenture holders of X Limited are discharged by Y Limited to 10% premium by issuing 15% own debentures of Y Limited. My first question is, no need to read, which is irrelevant component. Amount payable to debenture holders of the selling company is not form part of PC. Just leave it, time waste. Come to point number C. 14% preference shareholders of X Limited are discharged at a premium of 20% by issuing necessary number of 15% preference shares of Y Limited. Now, what is the face value of the preference share or existing number of preference shares in selling company? If you check here, we have 25,000, 14% preference shares is at 25 lakhs. Now, each preference share issued by the purchasing company with premium at the rate of 20 rupees, premium. That means simply number of 15% preference shares are same, but the issue price of 15% preference shares of Y Limited is equal to 25,000 into 120. Simply 25,000 into 120, which is equal to how much, guys? 25,000 into 120. Let me know quickly, all of you. 25,000 into 120, which is equal to 30 lakhs, na? This is amount payable to preference shareholders. This is amount payable to preference shareholders. Super. Next, come down, come to point number D. Intrinsic value per share of X Limited is 20 rupees and that of Y Limited is 30 rupees. Y Limited will issue equity shares to satisfy the equity shareholders of X Limited on the basis of this intrinsic value. However, the entry should be made at par only. The nominal value of each equity share of Y Limited is 10 rupees. Compute the PC. First, I am asking a question that what is the method of PC you should need to apply? In this question, what is the method of PC you should need to apply? Is it lump sum method? Is it net payments method? Is it intrinsic value method? All of you, please let me know quickly which method of PC I should need to apply. Net payments. That is absolutely fine. Now you are in the right track, guys. Now, out of this net payments method, amount payable to preference shareholders directly given. But to know amount payable to equity shareholders, I should need to apply another method, which is intrinsic value method. That is the thing I told you while discussing the theory. In PC calculation, there may be a chance of asking multiple methods in a single problem. But the overall method of PC is net payments method. For calculation of number of preference shares to be issued directly given, but for number of equity share need to be issued, you should need to apply the intrinsic value method. Now, if you combine, you will know the total amount of PC you should need to work out under net payments method. Okay. So first of all, let me check the same problem with one note. Once again, I'll read the problem for the required information one by one. All of you, please come here. Problem number 4. So again, method of PC is net payments method only. Now particulars, amount rupees. So two parties are there. One is preference shareholders. The other one is equity shareholders. First, 14% preference shareholders. Preference shareholders of selling company. Now we already worked out. So we are issuing 25,000. How much preference share each one? 15%. 25,000, 15% is preference shares at the rate of 120 each. At the rate of 120 each. So which we get 30 lakhs. Super. Next, come to equity shareholders of selling company. Now read the information carefully. Intrinsic value per share of X Limited is 20. Sir, how much worth you should need to pay if you want to know how many number of equity shares in the books of selling company? First, you should need to check. If you check, the number of equity shares in the selling company were given at 7,50,000. Now 7,50,000 into 20 is the amount you should need to pay. That is, concentrate all of you, 7,50,000 into 20 is the amount you should need to pay to the equity shareholders of the selling company. But each and every share, at how much price you are issuing? This, if you consider for the time being, if this is the PC, if you divide this component with the issue price, then you will get number of shares issued as PC. Just to divide this component with the number of shares, guys. If you divide this component with the issue price, you will get number of shares issued as PC. Now issue price is how much? In Y Limited, each share we are issuing at 30 rupees, which is intrinsic value per share in purchasing company, divided by 30. Then this component is number of shares issued. Multiply with the face value, then you will get PC is recorded par value. Now multiplied with face value means face value is given at 10 rupees into 10 rupees. Now this is the worth of amount you should need to pay to the equity shareholders of the selling company when it is recorded at par value. Do you understand, all of you? So please write the same thing. That is 7,50,000 equity shares issued to equity shareholders of selling company when it is recorded at par. We are working. Now, what is the component? What is this calculation figure? May I know? Guys, all of you, please let me know. While calculating PC, is it necessary to differentiate share capital and securities premium? Not required, ma. No need to split the securities premium, how much, share capital, how much at this stage. We should need to know only one thing, how much amount you are paying actually. Okay. Let me know, guys, what is this? How much value we are getting? 50 lakhs. Am I right? This component value is 50 lakhs, right? Tell me, yaar, 50 lakhs only, right? The worth, if you multiply with 10 rupees, you are getting 50 lakhs only, right? Now 50 plus 30, how much is the total amount of PC? 80 lakhs. Now this is the first time you are come crossing part of the PC amount is recorded at par value. Now if you are observing amount payable to the preference shareholders, you are recorded at issue price only, but amount payable to equity shareholders, you are recorded at par value. That is the reason why in theory I clearly explained, whenever the purchasing company want to decide record the total PC at par or part of the PC at par, it should need to multiply with the face value. If you know the number of shares issued as PC, how do you get the number of shares issued as PC in case of intrinsic value method? Number of equity shares in selling company into intrinsic value per share in selling company, which is nothing but the total amount you should need to pay in the form of equity shares. Then how many number of equity shares you should need to issue? If you divide with the issue price, which is intrinsic value per share in the purchasing company, then you will know the total number of shares issued. Multiply with the face value, you will get the worth of equity shareholders you should need to issue to the shareholders of the selling company when it is recorded at par. Now, if you make it total, you will get the purchase consideration. That's it, guys. With this, I think so. All models of PC I covered. Net payments we seen. NAV anyway we seen through problem number 1 while resolving accounting treatment in the books of purchasing company. We calculated NAV. That's why I don't want to take it separately. Next, in problem number 4, we are also applying the concept of intrinsic value method as well. Fine. Now, without wasting much time, let me entering into the next problem, guys. All of you, please come to problem number 5. Okay. Sir, till now, are you with me, right? Are you with me? Can I proceed to problem number 5? Or before going to problem number 5, let me know if you have any doubt quickly. Just let me check. Sir, if we have sufficient information to find PC by multiple methods, then which method we need to give preference to? Not like that, now. Which method means there is only one method is applicable. Multiple methods means for knowing amount payable to preference shareholders, you may apply other method. For knowing amount payable to equity shareholders, you may apply other method. But whenever there is a proper information is there, for computation of amount payable to equity shareholders and preference shareholders, always the method of PC is net payments method only. In general, the method of PC is known as net payments only. But to ascertain the amount payable to equity and preference shareholders, you may apply the different methods. If you are applying the different methods, you may not call with that method. You are always calling that method name is net payments only. Okay. Sir, please repeat what is the basic difference when we record at par or otherwise? It's very simple, ma. Sir, if PC is recorded at par value means always you should need to multiply with the face value. For example, in the same problem, guys, he is not adding one word. No need to record PC at par value. Just open. Let me open. In the same problem, for example, however, the entry should be made at par value is given. Now, this information is not there, let us assume. Then what I should need to do? No need to multiply with this 10. And no need to work out how many number of shares issued as PC. I should only need to work out number of equity shares exist in the selling company multiplied with the intrinsic value per share in the selling company. Then 7,50,000, you can simply multiply with the 20. Then how much it will become, guys? 7,50,000 into 20 means 1 crore 50 lakh. Tell me, yaar, anyone? How much worth it is? 1.5 crore. 7,50,000 into 20. I think so, which is yes, which is equal to the 1.5 crore. Then 1.5 crore plus 30, which is equal to 1.8 crore is the PC. Which is equal to 1.8 crore is the PC. Sir, but still right now we are getting 80 lakhs now. How 1.8 crore is equal to 80 lakhs, sir? It's equal. The impact is equal. Whether you recorded PC is at issue price, whether you are recorded PC is at par value, the impact is equal. I told you in the beginning of the class, but I told you at that point of time, you may not realize that fact at that point of time. If you want, I'll prove that right now itself. Please concentrate. So just I'm deviating from the problems. Let me take one simple case. What is that case is, sir, PC is there, NAV is there, sir. PC, let me consider 1 lakh. NAV, let me consider 1.2 lakh. Sir, PC, how many number of shares you are issuing as a PC, sir? How many number of shares you are issuing as PC, sir? I'm issuing 5,000 equity shares multiplied with 20 each. Sir, face value is 10 rupees only. but issue price is 20. It will become 5,000 into 20 means, which is equal to 1 lakh. Am I right? Now, all of you, please let me know. The case is PC greater than NAV or PC less than NAV. PC is less than NAV, right? Sir, if PC is less than NAV, is it goodwill situation or capital reserve situation? Is it goodwill situation or capital reserve situation? This is the situation for capital reserve, which is equal to 20,000. Tell me, all of you. Now, what is the journal entry at the time of recording the second entry in the books of purchasing company? Sir, assets taken over at the rate of agreed value to liabilities taken over at the rate of agreed value. Now you should need to cancel the business purchase. Now you can incorporate the capital reserve to the extent of 20,000. Am I right? Now at the time of making settlement to the liquidator, what is the entry you might pass? Just a moment. Liquidator of selling company account debtor to equity share capital to securities premium. Sir, to equity share capital to securities premium means 5,000 into 10 rupees, which is 50,000 in the form of equity shares, in the form of securities premium 50,000. Sir, real PC, how much? I don't know all such stuff. Only the impact I am telling you. Now you are recording the PC is at which price, guys? You are recording the PC at a issue price. You are recording the PC at issue price. Now, if the same PC, if I want to record it par value, what will happen? I will check. Again, purchase consideration 5,000 into, now number of shares issued as PC as 5,000 into par value. Therefore, purchase consideration is equal to 50,000. NAV is same 1.2 lakh. For the same situation I am applying now. Again, PC is less than NAV or PC is greater than NAV. PC is less than NAV and the capital reserve is now 70,000. Do you agree? Now come to the same second entry. Please, all of you come to the same second entry. Assets to liabilities to capital reserve. How much? 70,000. Come to the third entry. Liquidator of selling company account debtor. How much I should need to pay? 50,000. To equity share capital. Because PC was I decided as 50,000 and each share is issued at par value only 50,000. Now, if you're observing PC is recorded at issue price with PC is recorded at par value, there is no difference in my point of view. How you know? Here capital reserve I got 20,000. In third entry I got securities premium as 50,000. Capital reserve is a capital profit. Securities premium is also a type of capital profit which cannot be utilized for declaration of dividend. Securities premium will have a restricted usage. Now if you add 20,000 plus 50,000, you will get 70,000. The same 70,000 here reflected in the form of capital reserve, 70,000. Sir, if the shares are issued at issue price, I mean, if the PC is recorded at issue price, then the capital profits are reflected some portion in capital reserve, some portion in securities premium. If the same PC is recorded par value, then the entire portion is recorded as a capital reserve. That's why there is no difference in both the angles. That is the reason why from inception onwards, I am telling that whether you are recording PC at issue price, whether you are recording PC at par value, there is no impact in purchasing company books. Is it okay? Anyway, for selling company, there is no impact because just they are getting the number of shares, just they are distributing. The value of the shares they know. Is it clear, guys, all of you? Is it clear? Sir, this concept, why both the impact is same? Why it is correct? Nowhere explained. No author is explained. No material is explained. Just we can analyze the things by applying a single case. Whenever you are having any doubt, not only in the accounting subject, for any subject, please all of you take the case and apply the consequences, what will happen. Then you can really understand the provisions of that case. Okay. Clear. Super. Next, come to the next problem, guys. We are exactly having 30 minutes time. Let us try to resolve problem number 5 within the 30 minutes. Okay. Still, I can able to spend one more class for the amalgamation, or at the end of the tomorrow class, at least we should need to start the introduction for internal reconstruction. Okay. At least for last 15 minutes, 30 minutes like that. That's why still we have a lot of time. No worries. So peacefully we can able to resolve. some more problems. Janis, what's your doubt, ma? Sir, but sir, equity shareholders will get only 50,000 instead of 1 lakh. Who told, yeah? Who told? Equity shareholders will not get 50,000. They are getting that much of worth of face value of equity shares. But if you go to the real market, the market value is always 20 rupees only. Do you understand? Just for recording, we are telling that you are getting 50,000 face value of equity shares. But what is the real market value in the outside market? Which is 1 lakh only. So here, no one will lose. No one will lose. Everyone will get as per their own agreed agreement only. Do you understand? Here, for recording purpose, I work out 50,000. That's okay, fine. This is the face value of the equity share. But what is the real market value? Real market value is 1 lakh. You should need to understand that part. Okay, fine. All of you, please come to problem number 5. The following draft balance sheets are given as on 31st March 2014. Fixed assets, here 2 companies are there. One is Best Limited and the one is Better Limited. Investments are there. Current assets are there. Share capital, now you can replace the fixed assets with PPA, guys. Nowhere there is a place for fixed assets in the books of accounts. So share capital was given, face value 100, reserves and surplus is there, other liabilities is there. Next, the following further information is given. Better Limited issued bonus shares on 1st April 2014 in the ratio of 1 share for every 2 held out of reserves and surplus. In the ratio of 1 share for every 2 held means for every 2 shares, the company Better Limited, before occurring of amalgamation, certain internal changes are there. For every existing 2 shares, the company is going to issue 1 bonus share. At the time of issue of bonus shares, what is the entry? Reserves and surplus to share capital. But which reserves we should need to use, which reserves we may not use, all such things you may already learned in group 1 bonus shares concept. So here simply there is no difference, simply we are using the reserves and surplus. Now first of all, how many number of bonus shares we should need to issue? Let us calculate. For every 2 shares, for 1 share means now we are having existing 10 lakh worth of equity shares. So face value is 100 means, so 10 lakh divided by 100 means we are having how many number of shares here? Existing. All of you let me know existing how many number of shares are there? 10,000. Existing we are having 10,000 equity shares are there. Now for every 2 shares we are issuing 1 share means for 10,000 shares how many number of bonus shares? 5,000 number of bonus shares into 100 means 5,000 into 100 means which is equal to 5 lakhs. Now the entry is reserves and surplus account that are to equity share capital 5 lakhs. I should need to reduce 5 lakhs from here. I should need to add here. Then the new equity share capital will become 15 lakhs and the new reserves and surplus will become 3 lakhs. That is the impact in the Better Limited. Fine. Next, further, it was agreed that Best Limited will take over. Best Limited is a purchasing company. Will take over the business of the Better Limited. Better Limited is a selling company on the basis of the latest balance sheet. Latest balance sheet means after increase of share capital and decrease of reserves and surplus. Okay. The consideration taking the form of allotment of shares in Best Limited. Simply Best Limited is allotting certain shares. How the shares are issuing? They are providing information through point number C. The value of shares in Best Limited was considered to be 150. The value of share per share in the purchasing company is 150. And the shares in Better Limited were valued at 100. After the issue of bonus shares, the allotment of shares is to be made on the basis of these values. The allotment was happened on the basis of these values. All of you let me know PC is under which method? PC is under which method? Tell me quickly, all of you. PC is under which method? Method of PC I required quickly. No one is providing, yeah. Still, I am waiting for your answers. Sir, selling company will have certain value. Purchasing company will have certain value. Based upon their valuation mechanism, purchasing company is going to issue certain number of equity shares. Then the PC is Net payment, net payment, net payment. PC is intrinsic value method. Intrinsic value method. How you can tell, sir? Simply what he is telling, he is not using the word intrinsic value, but everything he is providing as like intrinsic value only. Just concentrate. One more time I will repeat, then you can easily connect. The value of the shares in Best Limited was considered to be 150. The intrinsic value per equity share in purchasing company is 150, and the shares in Better Limited were valued at 100. Each equity share value in the selling company, intrinsic value per share in the selling company was 100. After the issue of bonus shares, the allotment of the shares, the PC is to be made on the basis of these intrinsic values. If you add the intrinsic value, everything is connected. Do you understand? So that means simply PC is equal to how much, sir? PC is equal to number of equity share in selling company multiplied with intrinsic value per share in the selling company. Now, how many number of equity shares are there in the selling company? If you check after issue of bonus shares, 15 lakh divided by 100 means total we have 15,000 equity shares. PC is equal to number of equity shares in the selling company multiplied with intrinsic value per share in the selling company. Intrinsic value per share in the selling company was given at 100. That's why PC is equal to 15 lakhs. But if the same question, if I asked that, how many number of shares issued as PC? Then 15 lakhs divided with intrinsic value per share in the purchasing company, you should need to divide. Then you will get 10,000 number of shares. Number of shares issued as PC was 10,000 shares only. Do you understand? But the amount of PC is 15 lakhs. And one more thing, here no need to know the number of shares issued as PC. You are not recording the PC at par value. If you are going to record the PC at par value, then you should divide it with intrinsic value per share in purchasing company, then multiplied with face value per share. But like that, he not provided any information. That's why no need to divide the intrinsic value per share in the purchasing company and no need to multiply with the face value per share. So directly the simply PC is equal to intrinsic value per share in the selling company into number of equity shares in selling company. Do you agree, all of you? Is it okay, guys? PC is equal to how much? 15 lakhs. Fine. Can I continue? Next. Some of our student is telling that PC is 10 lakhs. No, ma, PC is not 10 lakhs. PC is 15 lakhs. If the PC is recorded at par value, then it might be 10 lakhs. Do you understand? So PC here is only 15 lakhs. Fine. Now let me read the further information. Liabilities of Better Limited include 1 lakh due to the Best Limited for purchases from it, intercompany owings. The first line of point number D is related to intercompany owings, on which Best Limited made a profit of 25% of the cost. The goods of 50,000 out of the said purchases remained in the stock on the date of the above balance sheet. And the last sentence of point number D is related to stock reserve. Now let me know the stock reserve is how much, all of you? Sir, made profit of 25% of the cost means this 50,000 is representing at 125. 125 is equal to 50,000, out of which 25 is how much? That equal to 25 by 125 into 50,000. That equal to 10,000 will be the stock reserve. Super. Now what they required? Make the closing ledger in the books of Better Limited and the opening journal entries in the books of Best Limited, and prepare the balance sheet as at 1st April 2014 after the takeover. Now quickly, sir, I am unable to resolve the problem in detailed manner because we are having very less time. So let me quickly give the synopsis. Okay. And not only the synopsis, I'll provide the entire answer, but not in detailed manner. Okay. Problem number 5. First, calculation of PC under intrinsic value method. PC is equal to number of equity shares in selling company into intrinsic value per share in selling company. So number of equity shares for 15,000 into intrinsic value per share in selling company was given at 100. Therefore, PC is equal to 15 lakhs. Next, this is working note. Actually, they are not provided as not asking as a separate question. You can provide it as a working note. Now you can go to accounting treatment in the books of selling company, guys. Now accounting treatment in the books of selling company. So what is the selling company name? All of you let me know. Better Limited, right? Better Limited. 5-step approach, all of you apply. 5-step approach means first, dismantling of balance sheet. So dismantling of balance sheet means assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book values. Open the realization account quickly. And you can also open equity shareholders account. You can also open purchasing company account, which is Best Limited. Here, what purchasing company going to issue? Equity shares of purchasing company. Equity shares of purchasing company also you can open. Sir, here nowhere mentioned which asset is taken over, which asset is not taken over. If like that information is not provided, you can simply assume that all assets taken over, all liabilities taken over. So that's why, please all of you make it transfer to the realization, all the assets in realization to fixed assets only transferred related to the Better Limited. 15 lakhs. Next, current assets 5 lakhs. Next, come to liabilities. Liabilities is only other liabilities exist here. Other liabilities is given at 2 lakhs, right? So by other liabilities given at 2 lakhs. Only at book values only you should need to transfer. Next, assets forward, liabilities forward. Next, shareholders funds, that is equity shareholders funds, reserves and surplus and equity share capital. By reserves and surplus, how much reserves and surplus? 10 lakhs. Sorry, you should need to check for Better Limited, right? For Better Limited, after issue of bonus share, reserves and surplus became how much? Tell me, 8 minus 5 lakhs means it became 3 lakhs. So that's why you should need to transfer 3 lakhs to the equity shareholders fund. By equity share capital. After issue of bonus shares, equity share capital became 15 lakhs. Now, all the assets and liabilities which are taken over by the purchasing company closed and transferred to realization at book values, and equity shareholders fund transferred to equity shareholders account. There is no preference shareholders fund. Next, PC due. Purchasing company account at to realization account. In purchasing company to realization. So PC we already calculated in working note number 1. So PC is how much, guys? 15 lakhs we got. In Best Limited, which is to realization, in realization by Best Limited. If you want, you can put working note number 1, which is 15 lakhs. PC due is over now. After PC due, PC receipt. What you are receiving? Equity shares of purchasing company accounted are to purchasing company. That's why by equity shares of purchasing company, which is 15 lakhs. In Best Limited, by equity shares of purchasing company, then equity shares of purchasing company to Best Limited, which is for 15 lakhs. So with this, actually Best Limited is closed. If you observe with this, Best Limited is closed. Then after receiving of the PC, you should need to distribute the PC in the particular order. Any liquidation expenses information was given in the problem? No. After that, any of the liabilities not taken over by the purchasing company. So that's why secured, unsecured, no need to think. Preference shareholders not exist. That's why you can directly distribute to equity shareholders account. But before distributing them on the equity shareholders account, find the realization profit or loss. How much profit or loss here? This side I got 20 lakhs. This side I got 17 lakhs. So realization profit or loss, this side you may get by equity shareholders account, which is 3 lakhs. Now in realization by equity shareholders, then equity shareholders to realization, which is 3 lakhs. Am I right? Now, if you close the equity shareholders, how much balance is there? 15 plus 3, 18, 18 minus 3, 15 lakhs. How much amount payable to equity shareholders? 15 lakhs. To pay equity shareholders, which resource you have? equity shares of purchasing company I have. Now the equity shares of purchasing company, you can simply make it pay to the equity shareholders. Then equity shareholders to equity shares of purchasing company for 15 lakhs. With this equity shareholders account close, then equity shares of purchasing company by equity shareholders account 15 lakhs. With this account also closed. Now all the accounts in selling company automatically closed if you apply simple 5-step approach. Is it okay, guys? All of you with me? Within how many minutes you completed this? Just a simple 5 minutes. That means if the information what they provided is in crispy manner, if you design the entire problem in a systematic manner, you can resolve the problem like anything. Okay, fine. Come down. Are you with me, all of you? Can I proceed? Are you with me, right? Can I proceed, guys? Yeah. I'm proceeding to accounting treatment in the books of purchasing company. That is accounting treatment in the books of Best Limited. Now, what is the first and foremost entry, sir? Business purchase entry. Business purchase account at R2. Liquidator of Better Limited. At which price you are purchasing? For 15 lakhs you are purchasing the business. Now you should need to incorporate the assets and liabilities by cancelling the business purchase. So assets and liabilities agreed values are not given. You can directly incorporate with the book values itself. So fixed assets account at are 15 lakhs. Okay, consider this. Next, current assets you can consider with 5 lakhs. Okay. To liabilities, which liabilities are there? Other liabilities are there. To other liabilities, how much, which is 2 lakhs, which is NAV of the business taken over. It should need to compare with the PC, that is to business purchase 15 lakhs. Now if you cross check, the NAV is how much? 15 plus 5, 20, 20 minus 2, 18. 18 lakhs is the NAV. PC is how much? 15 lakhs. So PC is less than the NAV. If PC is less than the NAV, which is capital reserve equal to 3 lakhs. Then you can incorporate here capital reserve, which is 3 lakhs. Next, come to the settlement entry, that is liquidator of Better Limited account at R. How much you need to pay? 15 lakhs. But how many number of shares you are issuing? 10,000 shares only. Each share you are issuing at the rate of, tell me guys, each share you are issuing at the rate of 150 rupees per each. That's why to equity share capital, 15,000 shares into face value 100 rupees. Always you should need to make it create with the face value only. Sorry, 10,000 shares, right? Not 15,000. 10,000 shares into 100, which is equal to 10 lakhs. The excess over and above the face value is securities premium. To securities premium account, which is 5 lakhs. Guys, apart from this, if you observe in point number D, intercompany owings are there. Liabilities of Better Limited included 1 lakh due to the Best Limited. Now liabilities means both are there under which liabilities are under other liabilities portion only it is there. Then what is the entry you should need to record, sir? One is under other liabilities and another one is current assets. It is clearly given that liabilities of Better Limited include 1 lakh due to the Best Limited. Now liabilities of Better Limited means now out of these other liabilities, you should need to make it set off with the current assets. Actually, that asset and liability information should need to be provided accurately. But here, as per the information given in the problem, which asset you should need to set off with which liability, they are not given. That's why you can presume that other liabilities you should need to set off with the current assets. So the entry is, so the entry is other liabilities account at R to current assets. How much? 1 lakh is the intercompany owings. Simply liability to asset is the entry. Super. Next, after that, we already found how much we should need to work out the stock reserve, how much we should need to maintain as a stock reserve. The goods of 50,000 out of the set purchases remain in the stock on the date of the above balance sheet. you should need to eliminate the unrealized profit lying in the closing stock to show the stock at the cost price. So now the entry is goodwill account at R2, stock reserve account for 10,000. Goodwill account at R to stock reserve account 10,000. Yes, please all of you observe one thing here. Sir, in entry number 2, we derived the capital reserve. In entry number 5, we have the goodwill. Sir, can I knock off goodwill with capital reserve? Yes, I can knock off goodwill with capital reserve. So rather than recording one more entry, what I will do, I will directly debit the capital reserve here. You understand what I am telling here? If you want to raise the goodwill, raise the goodwill. Later on in another entry, what I will do, capital reserve account at R2, goodwill I will write. Then goodwill cancel. Then ultimately capital reserve account should need to be debited now. Then rather than writing one more entry for cancellation of goodwill and capital reserve, directly here I am debiting with the capital reserve itself. That is capital reserve account at R2 stock reserve account. You can pass that entry also. Is it okay to all of you? Fine. Now let us go to the balance sheet. So balance sheet of Best Limited after amalgamation. Quickly. Guys, please all of you participate. Here I unable to explain the Schedule 3 format once again. I hope you already know about Schedule 3 format. Just I will tell you here what are the logics you should need to follow while drafting the balance sheet. Sir, if the company is a new company, always the PC will be the share capital. If the company is an existing company, then existing share capital plus PC will be the new share capital. Now, number 1, here equity and liabilities. Out of that, shareholders fund. A, you can start with share capital. Actually, you should need to provide note number 1. If you go to notes to the balance sheet, here, let me consider the notes. The note number 1 is share capital. Come here, come to Best Limited. All of you only think in Best Limited angle. Now we are already having the existing share capital at 20 lakhs. Now, how many number of shares you issued as a PC? 10,000 shares are issued as a PC. Each share is issued at the rate of 150. Face value is 100. That is 20 lakhs plus 10 lakhs. It will become 30 lakhs. So existing equity share capital, that is at 20 lakhs plus 10,000 shares issued as PC, which is 10,000 into 100 rupees, which is 10 lakhs. Now 20 lakhs plus 10 lakhs is equal to 30 lakhs. So the same 30 lakhs you should need to show under here. Next, B, reserves and surplus. You can go to note number 2. Come here, note number 2, reserves and surplus. Guys, all of you please concentrate. In Best Limited, what are the existing reserves and surplus balance? Which is 10 lakhs. So existing was 10 lakhs. Am I right? Existing reserves and surplus is 10 lakhs. Next, here there is no bifurcation. All the reserves and surplus simply I am adding. Now, in entry number 2, concentrate all of you, we are having capital reserve of 3 lakhs. And in entry number 5, there is a debit of capital reserve of 10,000. 3 lakhs minus 10,000 is 2,90,000. So capital reserve in bracket 3 lakhs minus 10,000, we have 2,90,000. And one more thing, securities premium is also there in entry number 3, which is for 5 lakhs. So total 17,90,000 will be the reserves and surplus. If you go up and put down 17,90,000 for the reserves and surplus. If you check in point number 3, securities premium is that was also considered by me. Next. What else? What are all the other liabilities? Nothing was given. So simply you can take number 2, other liabilities. Non-current, current, don't differentiate it because here it is not given. Other liabilities, first, Existing is how much? 20 plus 20 plus. Add a line by line addition of better limited and best limited. 20 plus 2, 22. Intercompany owings you set off na. Intercompany owings you set off the other liability with 1 lakh na. There is a debit of other liability. So you can reduce minus 1 lakh. So 20 lakhs plus 2 lakhs minus 1 lakh. How much? Tell me, yaar. We have 21 lakh. Simple line by line addition of assets and liabilities remaining all. So this is all about liabilities. Next, come to assets component. Under assets, number 1, non-current assets. Under that PPE, property, plant and equipment. Yeah. Sir, PPE are the fixed assets. It was given. Now 25 plus 15. Simply line by line addition. 25 plus 15, which is equal to 40 lakhs. Next, after that, investments. Only we have existing investments. That is 5 lakhs. Next, come to current assets. I'm not having the space. I'll record here. Concentrate. Number 2, current assets. Okay. Current assets existing for best. Yeah. Current assets it existing for best 20 lakhs. And for better, which is 5 lakhs. Now concentrate all of you. While set offing intercompany owings with each other, current assets we are crediting for 1 lakh. Crediting means we are reducing. We are reducing minus 1 lakh. Not only that, in the current assets, we are having other component, which is stock reserve. Sir, stock reserve means decrease in the stock value. Where the stock is there, current assets. That means indirectly we are reducing current assets only. So that's why stock reserve also you should need to reduce here. Minus 10,000. Let me know the amount. 25 minus 1, 24, 24 minus 10,000, which is 23 lakh 90,000. Please, all of you make it total of the assets and liabilities here. What is the total of liabilities, guys? First of all, 30 plus 21, 51. 51 plus 17.9. 68 lakh 90,000. Correct? Here also you can check. Asset side quickly, guys. Just a moment. Yeah, now you can check. 40 lakhs plus 5, 45. 45 plus 23, 68. 68 lakh 90,000. This is 23. Okay. So if you check, total of the liabilities is equal to total of the assets, guys. So with this, we successfully completed total 5 problems. Total 5 problems we successfully completed. Guys, in theory part, I explained everything except one thing. If the amalgamation is amalgamation in the nature of merger, then in the books of purchasing company, we should need to adopt pooling of interest method. So in the next class beginning, I'll explain the theory related to pooling of interest method. It's very easy. Once you understand what really happened and how it is different from the purchase method, if you understand that is more than enough, you can easily resolve any problem on the basis of amalgamation in the nature of merger. After completion of theory, let us take 1 to 2 problems based on amalgamation in the nature of merger as well. Then we will check based upon time for the remaining all other problems. But before that, I'll give one problem as HW. Please, all of you complete this problem as HW, guys. Problem number 6. This is only related to accounting treatment in the selling companies, guys. Here, calculation of PC plays the crucial role. You are going to calculate the PC under NAV method. So please, all of you take it problem number 6 as HW. Please complete the problem before coming to the next session. And one more thing, answer, that is the solution material, was also uploaded by me at the time of uploading the main material. Don't copy the solution material. First, all of you resolve the problem on your own. Definitely you may stuck off. Definitely you may go into the other direction in somewhere. There is a possibility because the problem type is like that. If you are successfully resolved, that is well and good. If you are unable to resolve the problem, somewhere you stuck out, then you can take the help of the solution. What mistake done by me, where I committed the mistake, you can cross verify. Then accordingly rectify your problem and complete the problem. Definitely that way of completing the solution will give much more confidence, which will help to resolve any difficult problems which they might ask in the examinations. Until bye, signing off. Goodbye, guys. Once again, happy Sivaratri to all of you.